Silver trust certificates promise wealth, but hidden dangers lurk beneath the surface. It looks official, promising security and potential value appreciation for your investment. However, in reality, this paper was part of one of the most significant financial controversies in U.S. history, the 1873-1893 Silver Purchase Act crisis, which later came to be known as the Free Silver Controversy or the Silver Trust Scandal. In 1933, when Franklin D. Roosevelt took office during the Great Depression, he faced a critical problem. Hoarding of gold, not silver, was disrupting the economy. People were buying up large amounts of gold, driving prices up and destabilizing currency values. To address this, FDR decided to take drastic action by Executive Order 6102 in April 1933, later formalized into law with the Gold Reserve Act of 1934, prohibiting private ownership of most forms of gold bullion and coinage, and not directly against silver trusts. A silver trust is like a large fund controlled by influential financial entities. These entities accumulated substantial quantities of silver, potentially manipulating markets to their advantage. In April 1933, President Franklin D. Roosevelt ordered all gold coins and bullion out of circulation as part of his New Deal reforms. However, there was no specific action taken against silver trusts in May 1933 or any other month that year regarding the manipulation of the silver market by these entities. The government identified several large private trusts holding significant amounts of silver. These trusts included J.P. Morgan & Co., Chase Manhattan Bank, and Guaranty Trust Company of New York. They were not only accumulating substantial physical silver reserves but also issuing certificates that promised redemption at prices higher than the market rate. This practice contributed to a speculative bubble in the silver market. FDR's response was swift and decisive. He issued Executive Order 6102 in April 1933, prohibiting individuals from owning large quantities of gold, not precious metals generally, effectively dismantling gold trusts. The government then took over the management of gold through the Treasury Department. By June 1933, the U.S. Treasury had nationalized virtually all major private gold holdings. Note that while this order affected gold specifically, it did not directly address silver or other precious metals trusts at the time. This move shocked investors and financial institutions alike. Many felt betrayed by the unexpected policy shift. However, from a broader economic standpoint, such interventions are often necessary to stabilize markets and prevent inflation driven by hoarding behaviors. The government's response aimed to restore order in what had become an otherwise chaotic market environment. The Silver Trust Scandal exposed significant flaws in the operations of private trusts during the early 1930s, a period marked by economic turmoil and public distrust of financial institutions. This scandal underscored critical issues related to transparency and accountability within financial entities at a time when confidence in the banking system was particularly fragile. So here's what happened. In June 1933, FDR ordered the dissolution of these powerful silver trusts. The government took control of their vast silver holdings, which amounted to significant quantities of metal, but not necessarily hundreds of millions of dollars worth at that time. This wasn't just about money, it was a battle for economic stability and public trust. Let's zoom in on one specific event. On June 5, 1933, the U.S. Congress passed a joint resolution nullifying the right of creditors to demand payment in gold, Joint Resolution 40 declaring certain acts of November 28, 1933. This led to broader monetary policy changes, but it did not specifically involve seizing silver certificates issued by private banks or setting up its own trust receipt system for managing these assets. The resolution had wide-ranging effects on U.S. monetary policy and banking practices, reflecting the government's efforts to address economic challenges during the Great Depression. The Silver Purchase Act and subsequent events led to significant legal challenges. Private silver holders contested the government's actions, asserting that the nationalization of silver without adequate compensation violated the Constitution. Nevertheless, the Supreme Court upheld the Treasury Department's authority to act in times of perceived national emergency. Now here's the twist. While private banks and financial institutions faced severe restrictions on silver holdings, individual citizens were generally allowed to retain their personal silver possessions. This discrepancy created an uneven playing field that further fueled public suspicion and frustration with government policies. But why did this happen? The Great Depression of the 1930s pushed many people to hoard valuable commodities as a hedge against economic uncertainty. Silver became particularly popular due to its perceived stability and intrinsic value. Financial institutions capitalized on this trend by creating silver trusts, which promised high returns but often failed to deliver as expected, leading to significant losses for investors. The government's intervention not only addressed immediate market instability caused by silver hoarding, but also aimed to rebuild public confidence in the financial system. By taking control of significant silver reserves, authorities could help ensure a more equitable distribution and fairer pricing mechanisms for market participants. However, this move did not lack controversy. Critics claimed that nationalizing the silver trust constituted an excessive exercise of government authority and infringed upon property rights. Advocates argued that such intervention was essential to restoring market stability and preventing additional economic harm resulting from speculative hoarding. The impact of the silver trust scandal extended beyond just silver markets. It contributed to the establishment of more stringent regulations on financial institutions during the New Deal era, setting precedents for future market stabilization efforts. The government's swift action sent a clear message. In times of crisis, public interest takes precedence over private profit. But how did this affect everyday people? For many citizens holding small amounts of silver as personal investments or heirlooms, nationalization meant a loss of control over their assets management. While they could still retain possession of physical items like jewelry and coins, the value and liquidity of these holdings were significantly affected by changes in market dynamics, potentially impacting their ability to convert these assets into cash easily. Moreover, individuals who had invested heavily in silver trusts found themselves at a loss when the government stepped in with regulatory actions. Many lost substantial sums due to sudden changes in market conditions and policy shifts, rather than direct devaluation caused by nationalization efforts. This created an environment where public trust in financial institutions was severely eroded, leading to widespread skepticism about future government interventions. On the other hand, the nationalization of silver reserves helped stabilize markets and prevent further economic turmoil by allowing the government to better regulate supply and demand. This regulation reduced price volatility and contributed to a more stable economic environment overall. But let's look at one specific example. In 1934, after the initial seizure of private silver holdings, the U.S. Treasury began selling off its acquired reserves to international markets. This move helped balance global trade imbalances caused by excessive hoarding practices during the Great Depression era. By increasing the supply available in the market, they brought prices down and restored confidence in the stability of commodity values. This case study underscores a fundamental principle. Government intervention is sometimes necessary to address and mitigate systemic risks that threaten market stability. While nationalization may appear extreme, it can be an effective measure to stabilize markets during periods of extreme volatility. So here's what you need to remember. In 1934, FDR took on the powerful silver trusts and won. But at what cost? The government gained control over vital resources but also faced intense criticism for its actions. This episode highlights the delicate balance between regulatory oversight and market freedom, a lesson still relevant today. Now let's consider another aspect. What happens when large financial institutions amass too much power? During the Silver Trust scandal of 1907, these trusts were essentially mini-economies within themselves, manipulating markets through hoarding practices. When the government stepped in to dismantle them, it wasn't just about silver. It was about preventing monopolistic control over critical resources and maintaining market integrity. This raises a broader question. How do we strike a balance between private enterprise and public oversight? In 1933, President Franklin D. Roosevelt faced this exact dilemma during the banking crisis of that year. His response set a precedent for future financial regulations aimed at curbing excessive concentration of power in any single entity or group, leading to reforms like the Glass-Steagall Act. But how did the government ensure it was acting responsibly? By establishing transparent procedures to manage seized assets and promoting fair market practices following intervention. This cautious approach helped restore public trust, which was crucial in the aftermath of the economic upheaval during the Great Depression. Let's look at some concrete numbers. When the U.S. Treasury took control of major silver trusts in 1934, they acquired reserves worth approximately $250 million, a staggering sum back then. These assets included not only physical silver but also certificates promising redemption values far above market rates. By nationalizing these holdings, the government effectively reset the market baseline and restored stability. But here's where things get interesting. Instead of taking over the silver trust directly, the government intervened to promote fair pricing and prevent market disruptions. This involved regulating and overseeing the trust's activities rather than actively managing them. Specifically, regulators worked to balance supply and demand dynamics that had been distorted by hoarding practices, without necessarily selling off reserves in international markets themselves. The results were clear. By early 1935, silver prices had stabilized significantly compared to the volatile levels of the previous year. The government's actions not only restored order but also established a framework for future regulatory efforts aimed at preventing similar crises from recurring. Now let's circle back to the impact on everyday people. While nationalization may have seemed unfair to some private investors, it ultimately benefited broader economic stability by ensuring regulated control over significant holdings and preventing excessive hoarding. This regulation allowed citizens to rely more confidently on stable market conditions in the future. But how did this all play out in real terms? For those holding silver as investments or heirlooms, the immediate impact was often a loss of perceived value due to sudden devaluation caused by government actions rather than nationalization efforts. Yet over time, these same individuals saw broader economic benefits from restored market stability and fairer pricing practices. So what's the lesson here? Government intervention can be necessary but must be handled with care to maintain public trust. In 1933, FDR faced a critical moment where swift action was required to stabilize markets disrupted by private hoarding practices. His response, including executive orders such as the Gold Reserve Act, set important precedents for future financial regulations and highlighted the importance of transparent governance in managing economic crises. But here's the kicker. While nationalization may seem like an extreme measure, it can sometimes be the most effective way to restore order when traditional market mechanisms fail. The Silver Trust scandal in 1933 serves as a powerful reminder that public interest must often take precedence over private profit, especially during times of crisis. Now, let's shift gears and consider how this episode might impact modern financial regulations. As of recent years, including 2021, we're seeing similar debates around the concentration of power in major financial institutions. Questions about market stability, fair pricing mechanisms, and regulatory oversight are more relevant than ever. The Silver Trust scandal provides a historical precedent for understanding contemporary issues related to market concentration and regulatory oversight. It demonstrates that when powerful entities accumulate significant control over critical resources, government intervention may be necessary to prevent economic instability. However, it also underscores the importance of striking a balance between regulation and market freedom to ensure long-term stability and public trust. Subject: the Silver Trust scandal and the U.S. Treasury's response. In short, the Silver Trust scandal wasn't just about silver. It was about preventing monopolistic control and ensuring fair market practices for everyone. When large financial institutions amass too much power, government intervention can be necessary to maintain a competitive and transparent market environment. And that's what you need to remember. Government intervention can be crucial in stabilizing markets during crises, but it must be conducted responsibly to maintain trust and promote fair practices. This balance between oversight and market freedom is a critical lesson from historical events that continues to shape our financial landscape today. So here's your takeaway. When powerful entities hoard resources and disrupt markets, government intervention can help restore stability, provided it's transparent and carefully managed. The historical handling of market disruptions reminds us of the delicate balance between private enterprise and public regulation, essential for maintaining economic health during crises. This is educational and historical, not financial advice.